All right, next thing we're going to do, we need to get some forward numbers, forward-looking numbers for this company. That is, what do we expect them to do for revenues next year, EBIT, EBITDA, net income, that type of thing. We're going to get that using some equity analyst reports. And in this case, if you go into your valuation folder, you go to there's a comparable company data subfolder. You open that up. And then if you open up the research reports subfolder, you'll see that for each comp, we have an analyst report. All right, so this is where you're going to find the analyst reports for General Mills and Kellogg when you do your homework. And this is where we're going to pull the Heinz analyst report up now. All right, so this is a pretty typical analyst report. This is obviously authored by Credit Suisse on Heinz. The date on this was November 21st, 2008. Right. Basically what I did is tried to find the most recent analyst report just prior to our valuation date. Remember, our valuation date was December 19th. Credit Suisse had done one November 21st. Credit Suisse had also authored analyst reports on each of the other 4 comps that we're looking at as well. When possible, try and get analyst reports for your comps all from the same research firm or same analyst. All right. They all make assumptions, macroeconomic assumptions, embed those into their data. You want to make sure you're working off of consistent assumptions across all comps. They might be wrong, but at least they'll be wrong by the same amount across all of the comps. All right, so we've got Credit Suisse for Heinz. Credit Suisse did all the other 4 analyst reports too, and really pretty close to our valuation date. Okay, so we pulled this up. Again, this is a pretty typical structure. Obviously, they're going to tell us who they're writing about, usually give the ticker symbol. At some place on the first page, usually toward the top, they'll tell us what is the analyst rating. That is, does the analyst think this stock is a buy, sell, or hold? Sometimes they might call it outperform, market perform, underperform. Basically the same idea. Do they expect the stock to do well or do poorly over the next 12 months? In this case, they think Heinz is going to outperform the market. They're currently trading, at least as of the date of this report, at $39.57 a share. The analyst thinks that within the next 12 months, Heinz stock should hit 47 bucks. All right, so you usually find some summary of that. They'll talk about their 52-week price range, typically give market value of equity and enterprise value somewhere as well, just like this report does. All right, the research analysts who worked on this, their names, contact info is listed. I guess you could call them and tell them what a good or bad job they did. I've never personally called an analyst report or an analyst to commend them on their work, but I guess you could. And then there'll be a bunch of narrative, typically geared toward justifying the rating they've placed on the stock. Talking about what the company has recently done, talking about key developments in the industry. If there are any acquisitions in the industry, they'll probably mention it here. Key macroeconomic assumptions that they're embedding into their forecast. Again, really just trying to justify that rating that they've put on the stock. All right, in this case, telling us why they think it's an outperform. All right, I'm not going to read all the narrative. It'll probably put all of us to sleep. You can do that in your own time if you want. But somewhere on the first page, there typically will also be some type of financial and valuation summary table. Basically, what is revenue going to be next year, EBITDA. Sometimes they give EBITDA, sometimes they don't. Sometimes they give EBIT, sometimes they give net income. Sometimes they give earnings per share. Really can differ from analyst to analyst. But in most cases, you will find a summary table here, and typically there's some information that we can use from that. All right, we may pull some data from that in a little while. All right, next few pages, just more narrative. Not going to read that. But then toward the back, and this analyst gives a quarterly breakdown of earnings, both on an actual, 2008A for actual, and an estimated or expected basis, 2009E, 2010E for expected or forecasted, estimated, whatever you want to call it. So they've got a quarterly model, then they've got a breakdown. In this case, they break down Heinz across its different segments as well, which is interesting to look at. North America, US food, Europe, Asia Pac, rest of the world. All right, so that's kind of interesting to see. And then they've got a rolled up year by year forecast model, usually one of the last things in their analyst report. Okay, this is where we're going to be sourcing the key numbers for our analysis. This is where we'll source those from. All right, everybody find that in their report? So if we go back to the model, what we're looking for here, I need to get sales, EBIT, EBITDA, earnings per share, and CapEx. All right, so the first thing I want to get from my research report is sales for next year. In this case, this would be 2009 expected. Okay, so that would be 10,130. Next year after that, 10,080. I'm just going to enter those in. Next thing I need is EBIT. Right, and here's where this analyst report gets a little unusual in that if you look through here, there's no line for EBIT and there's no line for operating income, either in the model or on that summary page on the first page, in that summary table, I guess. Right, but what we do see here is earnings before interest, taxes, and amortization, EBIT-A. And then we see the line item directly above that, amortization, basically zero in every year. So in this case, EBIT-A is equivalent to EBIT. When you read analyst reports, sometimes you have to think a little bit about what they're trying to communicate. They might use some different abbreviations. They might make mistakes. Sometimes you'll see mistakes in their work. Oftentimes they're very glaring mistakes, I've seen. So you need to kind of be on your toes when you read an analyst report, kind of be looking for things to be phrased a little bit differently. For example, in this analyst report, there's no CapEx or capital expenditures. They call it capital spending. All right, so don't let different labels throw you off. But in this report, next year's EBIT, 1510, the year after, 1540. All right, so that's EBIT. Next thing we need in our model is EBITDA, EBITDA. We don't see it on the model page here, but it is, if we recall, it is in that table on the first page. So they give us EBITDA 1812.3 for next year, 1835.8 for the year after. Everybody see that? Okay, next item we actually need earnings per share. Also in this table, it's also in the back as well, but I happen to be on this table, so I'll just pull it from here. 288 next year, 265 the year after. Which is interesting because it's actually showing earnings per share going down in the next couple of years. Okay, which could be a couple different things. Maybe they are actually having lower net income. They also could have additional shares. Remember how we calculated earnings per share? All right, if they're forecasting a rising stock price, what's that rising stock price going to do in terms of dilution? It's going to bring a lot more options into the money. So they're probably estimating that more options will get exercised in the future. So net income might actually be going up, but if there are a lot more options, then it could actually reduce earnings per share. All right. So there are a couple different reasons why that could be going down. But it's interesting to see they're forecasting actually a decline. They actually forecasted a decline in revenues as well. All right. And then lastly, we need CapEx. Again, as we talked about before, the CapEx figure is called capital spending in this report, which is 355 next year, 353 the year after. Everybody see those right there? Now, in the case of General Mills and in the case of Kellogg, there won't be a capital spending line here. What you're going to do in your model is you're going to calculate the ratio of latest 12 months CapEx to revenues, right, to get a percentage. So in other words, if we did that for Heinz, like roughly 300 million divided by roughly 10 billion, about 3%. If we were to do that for Heinz, CapEx divided by revenues, roughly 3%, then we would assume that that ratio will hold going forward. So for next year's revenues, we'd multiply it by 3% to estimate CapEx. We'd do the same thing for 2 years out. Okay, so you'll do that for your homework for both for both General Mills and Kellogg. Right, so that's really all we need from the analyst reports. Again, you've got them for General Mills and Kellogg. Right, the only twist is using that CapEx as a percentage of sales to estimate CapEx for the next 2 years. All right, any questions on that? Last thing we need to do is we need to calculate dilution. If Heinz had convertible debt or convertible preferred, we would figure it in right here. All right, let's just do a quick example. Don't do what I'm doing, I'm just really follow along. Sorry about that. What I'm going to assume, just for illustrative purposes, is let's assume Heinz had $1 billion of convertible debt. They don't, but let's assume they do. That convertible debt would have been included in the long-term debt line item on their balance sheet, which we would have captured when we calculated total debt before, right? But let's assume they've got $1 billion of that debt as convertible debt. And let's assume that that is convertible into common stock at an exercise price or a conversion price of, let's call it $30 a share. Right?
Which is a strike?
That would be the equivalent to a strike price. In terms of convertible securities, we call it a conversion price. It's the same idea though. If the market price of the stock is over the conversion price, it makes more sense for the holder to convert because it's worth more. All right, so the same in the money, out of the money designations apply. But in this case, Heinz is trading, I know they're trading at like $37 a share. So I selected a conversion price that was purposely in the money to illustrate what would happen. All right, if they've got $1 billion of convertible debt outstanding at a conversion price of $30 a share, what that means is that that debt can be converted into 33.3 million shares of common stock. All right, now because it is in the money, that is because the current stock price exceeds the conversion price, it's worth more to the holder to convert it, so we're going to convert it and add that number of shares to our fully diluted share count. Right? And at the same time, we're going to deduct from total debt that $1 billion because this is no longer convertible debt. It's stock now. It's equity. We've converted it to stock, so we cannot double count. That's what I was saying earlier. And does everybody see that? Okay, so if you have convertible debt, really what you need, or convertible preferred for that matter, you need the face amount, and you also need the conversion price. The model will do the rest for you. It'll figure out, is it in the money? If it's in the money, it'll convert it to stock. If it converts it to stock, it'll add that number of shares to the fully diluted share count, and at the same time, it will deduct the original face amount from the amount of debt so as not to double count. And now the last thing I need to do is I need to go to my options table. Remember we talked about this before, and I need to figure out, based on the employee stock options that are exercisable, how many of them are in the money, and then the model's going to do that treasury stock method and figure out how many new shares would need to get issued to account for those option exercises. Does that make sense? All right, so where do I find this information? Back of my page, wow, you even remembered the page. Page 59 of the 10K. All right, toward the end of the notes section of my 10K, I've got my options table. All right, this table that we looked at before. Now the way our model is set up, the way our template is set up rather, is that we've got space for, I believe it's 10 up to, actually it's up to 9 different groupings of options. All right. In the case of Heinz, we only have 3, so we've got more than enough space. Basically, for each of these groupings, we'll have one line item. We'll enter the number that are exercisable. Then down below, we'll enter the corresponding weighted average strike price for each. And then the model will perform the treasury stock method here in this quote-unquote calculation section, figure out for each grouping of options is it in the money? If it's in the money, do the treasury stock method. Take the proceeds from those option exercises, go out in the market, buy back as many shares as they can, and then issue as net new stock only the balance. That is, the amount of stock that they couldn't buy back in the market. So that's all the model is going to do. As long as you understand this and you know where to find your data, the options section of this template is very easy to do. All right, so now last thing I need to do, I need to capture number of options that are exercisable, each of my 3 groupings, and the corresponding weighted average exercise price. All right. So we've got 7.326. Remember, these are in millions in the first grouping. 7.965 million options in the second. 3.958 in the third. I've just captured these 3 numbers. That's where I got them. All right. And then down below, need to enter the corresponding exercise prices. $33.31 for the first grouping, $40.71 for the next, $49.83 for the last grouping. And just by looking at these, if I know the share price, I can tell you which of these are in the money. If I tell you the share price is 37, then we can figure out real quickly just by looking at it that only the first grouping of options are in the money. For the other 2, no one's going to buy something for 30, or no one's going to buy something for $40.71 that's only worth 37. All right, that wouldn't be to their advantage. So these, there's no effect from these whatsoever. And these, what'll happen is we'll buy as many shares as we can, or we'll buy them at $33.31. Company will go out, take those proceeds, buy as many as they can at the current price, which is 37, and issue the balance of that 7.33 million as net new stock. And that is what is getting calculated down here in cell F203. And the net effect is that the company has to issue about 800,000 new shares. The rest of them they were able to buy in the open marketplace with the proceeds that they received from the exercise. Make sense? All right, so we're adding, at the end of the day, we're basically adding 800,000 to that 314 million share count that we had, the basic shares outstanding. We're adding 800,000 to it. Right? And that includes not just the options, it also includes the shares that would get issued or created upon conversion of the convertible preferred or convertible debt if there had been any. We'd add that total number to our to our basic shares, which would get us to, where is it? Fully diluted shares outstanding of 315.2. Okay, that's that basic share count, 314 and change plus 800,000. All right. And at this point now, we're done with spreading Hines. My numbers should match your numbers, and the model is able to calculate equity